Welcome to Amazon Legends, where we have real stories about making it big on Amazon. Our guests are CEOs of large companies and entrepreneurs who became power sellers, also providers specializing in helping sellers, aggregators that acquire sellers, and former Amazonians will give us an insight from behind the scenes. Here is your host, Nick Urison.
Welcome to another episode of Amazon Legends. My next guest today is a finance and private equity professional, but he got bitten by the data bug. So since he was dealing with numbers, he thought, well, there's more meaning to numbers. So today he's the founder and CEO of Nozzle, which is a provider of tools that help Amazon sellers understand their customers to grow their business, which we will get into in a minute. This conversation you are going to love because I've been searching for someone to have this conversation with. And here I have the man to do this because he's the one who built the platform and everything else. So plus he knows how to use them. So when he's not working with numbers, he loves jazz and progressive rock, basketball and soccer, where he likes watching the numbers. Again, he's watching, and in fact, for me also, one of the things that I'm fascinated with all the baseball numbers, how you are doing.
Exactly.
Story. So with that, everybody, meet my guest, Rael Cline. Welcome to the show, Rael.
Thank you, and thanks for the very kind introduction. It's great to be here, Nick. Very much looking forward to the conversation.
Oh, yes. This will be a lot of fun, and I'm sure listeners will learn quite a bit from it. So Amazon is a game of numbers. It's all about numbers, and you look at the numbers and then you make decisions. Ideally, in any business, you look at numbers, and you should look at numbers and make decisions rather than gut calls. But how you use them is different, and on Amazon is especially key to your success. So tell us your take on this. What do you do?
Yeah, so effectively for us, we focus on a set of metrics which are customer behavior related. And we think that Amazon does a pretty good job of giving you SKU or ASIN data, but really to understand a business, an e-commerce business, you really have to understand your customers. And what do I mean by their behavior? It's more about how often they come back, how often they're buying, are they buying the same products again? How long does it take between all these orders? All those sort of things, because that's what helps you build a brand. And it's your most valuable asset as a brand, right? Or those diehard customers, those coming back again and again, or your most valuable asset as an e-commerce brand. But Amazon doesn't give you that data, and that's basically what we do. We provide a suite of dashboards that shines a light on all the customer behavior. What does the data look like, and what decisions should you be taking to improve your business?
Okay, so as far as the academic approach, so to speak, so what we're looking at here is, from our conversation, I remember 2 data points that are key to decision making. Can you share with us what those data points are? And then also share just briefly, because we're going to dig into this, that how you get that information, how you calculate it.
Yeah, sure. So the two, I would say the two most important metrics would be this idea of customer lifetime value and customer acquisition cost.
So how do you calculate the customer lifetime value?
Yeah, so I guess first sort of a definition of it is, how profitable is an average customer over time, right? And we're talking about profitable here, not average sales per customer, which is useful, but not the most useful. But if you understand the fundamental business equation, the way we like to look at it is that if you understand how profitable a customer is over time, it answers a very, very fundamental question, which is the second metric. And that is how much you can afford to pay to acquire a customer, right? Those are two sides of the same coin there. If you know that an average customer is worth $50 to you after 3 months and $70 after 6 months, that means you can now afford to pay $50 to acquire someone if you want to break even in that 6-month period or whatever it is. And so looking at those two things in tandem, we think is a very fundamental business equation that ultimately gets overlooked by a lot of Amazon sellers. clearly you need to sell products that lend themselves to repeat orders, right? If you're selling very high price furniture, sure, you might wait 10 years before the next order comes. So it's not going to be all that useful. But certainly if you're in certain categories, some very big categories and competitive ones like pets and health and beauty and food and drink and supplements, household cleaning liquids, anything like that, where there's naturally going to be more than one order, you would think, this should become quite a fundamental metric that you should optimize for over time.
Yeah. Okay. So this is where the conversation is going to get interesting for especially listeners, because we are all business owners, right? So at the end of the day, when all is said and done, how much money you had in your pocket at the beginning of the day and how much money you are left with at the end of the day. We want to pay the bills and then put away some money. Okay. So therefore, the profit definition is different for everybody. When I say it's different for everybody, it depends on what the person is doing. If you make no profit, that means you're breaking even. That means whatever you're collecting is paying off your expenses. If you go to a PPC agency, to them, break-even point is whatever you generated in sales but that's not the case. So define for us, in your case, calculation of lifetime value.
Yes.
What is the definition of profit?
Yeah, so we analyze literally every single order that goes through your account. And so if we identify somebody as a unique user, we can discuss, if you want, how we do that. But let's say it's customer unique ID, right? So customer number 1234, and this customer buys a product. We will know that this customer bought this product at this time and shipped it to this particular address. And we will also, our customers will upload their cost of goods sold, right? The COGS data. And then we've got the Amazon fees. And so effectively for us, when we're talking about profit here, we're trying to get as close as possible to the actual price paid by the customer. So we're going to subtract out any discounts and coupons and all those sorts of things. Obviously all the sales tax or VAT and all those things too. Then we're going to subtract out the COGS data. Then we're going to subtract out all the Amazon fees. And that's pretty much what you're left with in terms of profit, right? And so even if you bought in one order, you bought 3 different products, we're going to do that for all 3 of them, right? And then we're going to say, okay, the profit on this order was, I don't know, $15, let's say. And then you come back and you buy again 3 months later and you just buy one product. Then we're going to do the same calculation again. And we're literally doing this for every single customer that's ever bought from you on Amazon. And we're going to be taking, an average or whatever it is. So how many of them come back after 1 month or 2 months or 3 months? We're literally, what is the average? Like for customer number 1234, what was their entire journey with us over the last 2 years, 3 years, whatever it may be? For customer number ABCD, right? A different customer, what was their whole journey? And we're literally going to be taking, averages of all those journeys to get a sense of what actually happens across your entire customer base over time.
Okay. So let's dissect that a little bit also to clarify.
Yeah.
One customer buys one item. When does this calculation start? Because when you say lifetime, do you wait before you include some of those customers in the calculation, or what is that minimum period, or is there such a thing?
No, I mean, it's literally as far back as Amazon's APIs allow us to go. So anyone who connects to Amazon's APIs is allowed to go back 2 years, right? And so we go back 2 years, we get, as I say,
what about new customers? Well, if somebody signed up yesterday, it's coming in for the first time for you. So immediately you establish a lifetime value?
Well, there's going to be in any brand, no matter how good you are, there's always going to be a significant chunk of people that just buy once and that's it, right? You never hear from them again. But that should count in the average, right? It's obviously going to bring the average down. But if you're talking about what does the average customer do, sure, 30, 40, 50, 60% of them will just buy once, and that's just life. But yeah, I mean, that's an important part of the calculation. You can't just exclude people who just bought once from you. From an average calculation, right? They're an important weight in that average. So yeah, you can talk about more sophisticated things around. We are very big on something called cohort analysis, right? And this is something that I think if people have used Google Analytics or things like that over time, they kind of popularize cohort analysis. And the idea there is you can split up your customer base over time. So let's say you want to take all the people that bought in January of 23, and let's say there were 1,000 people that were new to brand in January 23. And you want to track them over time. So anytime one of those 1,000 people buy again, some of them might buy 1 month, some of them might wait 3 months to buy again, some of them might never buy again. You want to track that as a cohort to see what happens to them over time. What happens to just that cohort average, right? And maybe that's $20 after 3 months, right? The average of those 1,000 customers is going to be $20 over 3 months. But then the power of this is that you can compare that to another cohort. Let's say people who were new to brand in February, 1 month later, right? They just converted for the first time in February. And you do the exact same analysis there. But now you notice that this cohort is actually only worth $15 after 3 months. That's $5 less than the January cohort at the same point in time, right? At the 3 month mark. Now, why is that? What happened? Are they less loyal? Are there just fewer people coming back and buying again? Is it because you gave massive discounts and therefore the lifetime value actually dropped? Remember, we're doing this on profit here, not on sales. And so you're starting off on a pretty bad footing. If you've given a huge discount, they're obviously not going to be as profitable. So there could be various reasons, but what this actually starts doing is giving you a sense of what the evolution of your customer base, right? Are my older customers more or less loyal than my newer customers? Or if I made a price change, I increased or decreased the price, what actually happened? Did I get a whole lot more new to brand customers? Are they more or less loyal, right? And so it's actually a very powerful analysis for, it's quite hard to do this, I guess, without like a visual, because it's very visual to see how this whole thing works. But the takeaway, I guess, is, a lifetime value in and of itself. If I had to just say to you, hey, Nick, did you know that for your brand, the lifetime value is $100? That is not that useful to you. What are you meant to do with that? Does that mean, okay, you can spend $100 to acquire a customer, but you might wait 5 years for that to break even, right? It's not, and in which case it's not that useful. And so when we talk about LTV, we should always be talking about an associated time frame, right? It's your 3 month lifetime value. It's your 12-month lifetime value, right? And because it's just much more useful to know what that progression looks like. And then secondly, we're always talking about what are the trends in that customer base, right? Is that LTV increasing or decreasing, right? According to this cohort analysis, are my newer customers more or less valuable than my older customers? Or we've had people make a change in their account. So for instance, they've embarked on some remarketing campaign, or they've made a price change, or they're doing some coupons, or I don't know, Prime Day, or, all that whole thing. How do you actually measure the effects of these things? You need a cohort analysis to do that, because you need to say, these people were exposed to some sort of change, right? I increased my price. Now, what actually happens? I need to track, 3 months, 6 months down the line to see what happens and compare that to the older cohorts to see whether actually this has worked. And what we've worked with a lot of our customers has been on specifically pricing, right? We've actually said, well, you've actually got a bit of room here to increase your price. And we've noticed that there's not really much of a trade-off in terms of new to brand customers. Obviously, their lifetime value is increased, right? Because you've increased your price, your margins are better, right? It's profit per customer, all that sort of stuff. And your customer retention rate, we can talk about what that is, but your customer retention rate doesn't suffer either, right? It doesn't really affect the number of people coming back and buying again. So I know I've spoken a lot about a real deep dive into all of this stuff, but yeah.
So, okay. So let's unpack a few things. So first of all, as far as the length of time is, you are defining 3 month lifetime value, 6 month lifetime. Yes. So you are measuring them separately. That means you're looking at the kind of time frame that number is associated with.
Yes.
Is that, if you are measuring 3 month lifetime value, is that 3 month shifting all the time, or is it just from the first purchase?
Well, if you're doing a cohort analysis, there's always going to be from the first purchase. So, as I say, we can roll it all up into some big average for the whole brand over 2 years sort of thing, which is useful, I guess. But if you really want to know what actions to take, and you need to drill down. So we would always say it's a 3-month LTV from the first purchase date, because that's what the cohort analysis will do. And what another big thing we're measuring is, what happens to this the 3-month, let's say, what happens to the 3-month LTV, right? For the January cohort, it was $20. For the February cohort, it was $15. For the March cohort, it's gone back up to $22, right? And so like you're actually seeing the trends in this lifetime value, and you're mapping that against what changes you made in the account to see what the effects are. I mean, relatedly, we can talk about other like things around like a 90-day retention rate, which is quite a common metric, I think, in like D2C type e-commerce businesses, which is to say, of all the people who buy for the first time, how many of them are going to buy again in the next 90 days? Right? And how many of them are going to buy in the next 180 days? Now, how do you decide what period is good for you? Like, what, I'm just using 90 here, like, okay, but that's kind of arbitrary. What we would say is we've got the data to say, how long does it take between the first and the second order, right? What's the distribution of orders? Some people are going to do some in the first 7 days. Some people are going to do days 30 to 60. But roughly what we would say is when about 80% of the people who would have bought twice have already done so, that's the purchase cadence, right? Like that's sort of the time period. And generally speaking, if you're talking about food and drink, and supplements and things like that, a 90-day period for most brands, you're going to have covered off about 80% of those repeat orders. Perhaps to illustrate this point, I've got a sort of counter example, which is we have a customer that sells water filters, and they only sell multi-packs, right? And so people are only expected to buy once a year. And so looking at something like a 90-day lifetime value or a 90-day retention rate makes no sense, because people are just not expected to buy, right? It only makes sense to look at this when people are expected to buy again. And in this case, it's 12 months, right? As an extreme example.
Well, I mean, two major takeaways from this part of the conversation is, first and foremost, there is no such thing as a standard lifetime value measurement or expectations, mainly because the answer is it depends. It depends on the category. What kind of products are you selling?
Yes.
Like
yes.
as you were talking, I was thinking myself, what is it
Absolutely.
that I buy several times from the same seller? And you know what came to mind? Pistachio nuts. So I have a seller on Amazon, and I buy it all the time. And, and I buy, they have it in 1 pound, 2 pound, and 5 pound bags. And I usually buy the 5 pound bag. And so it's not so much the size of the bag, but it's usually the bigger bag. But of course, that means that it's much longer in between purchases.
Exactly.
So the bottom line is, depending on your category, and within that category, depending on your SKU, every seller must decide for themselves how they will measure their lifetime value. What would make sense?
It's perhaps not so much how much they will measure the LTV, but what time frame makes sense.
That's what I meant.
Yes,
that's what I meant.
It's the time frame thing. So, for instance, our tool will also give you the information around what people buy next, right? So, people who first buy product A and they buy again from you, are they buying product A again, or are they buying products B, C, and D? And that could be a variation. It could be your example. They start off with 1 pound and then go to the 5 pound, or it could be in health and beauty, for instance. There's a lot of just cross-selling, right? They start off with hand cream, then they go to face cream, right? And so that's not a variation. That's just literally something different. Whereas stuff like, let's say, supplements, we would have people perhaps just starting off on a 30-day supply of supplements, but by the second or third order, they like it and they've gone to the 120-day supply of supplements, stuff like that. And so, looking at each individual brand needs to understand how often is that happening, and therefore adjust that time window that you should evaluate the LTV.
Okay, so the second thing that I picked up in the conversation that's, to me, is very important is, what is it that's happening at specific times that will trigger? Because it's if you're doing nothing and it's just a listing sitting there, that's one thing. You want to know that January and February and March, whatever, those are the things. The second, or if you're running a promotion, and if it's these are things that are, I had an former Amazonian on the show,
Right.
and those listening, great guy. His episode already came out. His name is Elvis. And he shared with me some of the terminology Amazon people would always use.
Right.
And one phrase applies here. They call it the controllable input. In other words, what is it that,
Yeah.
that you can do?
I like that.
You must record your controllable inputs.
Yes.
And then factor that into your analysis. In addition, some of the inputs are not controllable. For example, Valentine's Day, Mother's Day, Father's Day, if you're selling items, right? So it is so important to factor those events into the analysis so that you can get a good sense of, when you do that cohort analysis, of course, there will be a difference between a February batch and the July batch, because February had Valentine's Day, and so things like that, right?
Agreed. And I love that. I love that phrase. I mean, kind of 2 points for me on this. Number one is the lifetime value. We always describe it as an output metric, right? I mean, it's again, if I had to just give you an LTV, okay, it's nice conceptually, it's profit per customer at the 3-month mark, at the 6-month mark. But if you start getting into like, how do I use this metric to improve my business, or what levers can I pull to actually influence this number? Then you got to start talking about, pretty much what that phrase is, right? You got to start talking about input metrics, because an LTV is the result of all the other stuff that you're doing right or wrong in the business, right? And so I would always think about LTV as kind of three separate major categories of things that you can that influence it. Number one is going to be how many people come back and buy again, right? An obvious one, which is customer retention rate. So that's clearly a really important one. Number two is how many people are coming back in that specific time frame, right? That, because again, you're after a 3-month LTV or a 6-month LTV. The third thing is the margins ultimately, right? Because you can have somebody buying from you literally every single day, but your lifetime value is not going to grow, right? Because this is on a profit basis. If your margins are zero, your LTV is not going to grow, because this is a profit calculation. So again, then if you break it up and you think about, okay, how do I increase retention? Right, let's talk about the ways in which we can run some experiments to try and do that, right? And the various ways of trying to do that on Amazon. If you want to talk about trying to get people to buy, instead of buying every 6 months, let's try to get that number down, right? Let's try to get that number to 5 or 4 or whatever it may be. And so that's things about cross-selling and catalog selection, and 3 things you can do to help improve that. On the margin side, that's going to be a lot tougher to do, right? Especially in this environment. How do we improve your margins? Well, that's going to take a long time, and so there's fewer things you can do on that side. I totally get that, but that's the way to deconstruct the lifetime value, like, and then break it down into, that's what are the retention levers and all that sort of stuff. So I think that's really important. On your sort of on what's controllable though, what's really interesting, and I love talking about this, is you talk about Valentine's Day or any of these sort of big event, Prime Day, Black Friday, whatever it may be. It turns out for about 40% of our customer base, it's actually not worth doing any discounting at all. Don't do any discounting. And so the reasons are, and this part is controllable, right? This is one of the very few levers I guess you have on these big days, is do I discount or not? And if so, by how much? We've run lots of experiments. We've got lots of data on this. But if you're in one of these categories where you have a lot of repeat orders, there are a bunch of things that are going against you on these days. Number one is purely just on the customer acquisition cost side. It is much more expensive to acquire a new customer because CPCs are much higher, right? Number two is in terms of lifetime value, well, you're starting off on a pretty bad footing because you've given them a steep discount anyway, right? You're probably somewhere closer to break even, probably hardly making any profit at all. Number three, a huge chunk of these new to brand customers are deal hunting, right? So typically what happens is your customer retention rate drops a lot for people who were new to brand on Prime Day because they're just deal hunting. And so that's obviously really bad for lifetime value. And so your LTV actually decreases a lot. You also get, these are sort of second order or more minor effects, but these are also not good things. you'll get existing customers that would have bought on full price buying at a discount. And in extreme cases, we've seen existing customers buying bulk on a discount, which is obviously not what you want. So yeah, you've got all these sort of things that are counting against you. But there's one very big factor which can more than cancel out all of this, which is simply you get so many new to brands through the door that you would happily trade off some retention rates and some LTV, because in pure gross profit terms, the math still works out, right? But it's not clear. It's not clear, and that's sort of the deep dive, that I think people need to do to get a little bit savvier around this. And what level of discounting, or should you not even do it, or that kind of thing. So again, analyzing Prime Day, people always analyze their Prime days of like what happened during those 2 days, right? This is the amount of sales and all these kind of metrics, and it's like, well, we view them in a way as not vanity metrics, but they're not the most important metrics. What the most important metrics are, we have to wait 2 more months to see, right? We have to wait for what happened 3 months after Prime Day, right? Like how many of those people, what is the quality, quote unquote, of those customers, right? And is it, and how does the lifetime value compare to previous cohorts? That kind of thing. Yeah. Sorry, it's a bit of a tangent on all that, but I think that's quite an interesting sort of finding.
To all my listeners, how would you like to boost your Amazon sales by up to 600%? That means you must have a winning product detail page. Mindful Goods crafts product pages that pop. Their creative marketers ensure your products aren't just another face in the crowd, but they stand out and sell. From SEO optimized copy to scroll stopping visuals, they've got your back. And for a limited time, my listeners get $100 off a brand story service. Elevate your Amazon game with Mindful Goods. Visit www.mindfulgoods.co/legends now and enter the code Amazon Legends to receive your $100 off. You are a numbers person, and in terms of what numbers impact and what are the events that surround those numbers, and so therefore you have a very good understanding of how to utilize those particular days and events, or whether it's controllable or external. One thing that I will say as part of the consideration for monitoring the numbers for those peak days is purely to get a sense of inventory replenishment in the future.
Right. Yeah.
Because yes, you may. So I mean, really, I never thought about it that way. But when you put it the way you put it, you really don't want any of these peaks, because they or fabricated peaks, because they are hurting you in the long run, and you don't want that. It makes total sense. Okay, I want to just go back a little bit, because I want some clarification on a couple of things, and then I want to move on to the customer acquisition cost aspect of it. Calculation of lifetime value. First of all, just so that we are clear, this is a dollar value. It's not percentage, because some metrics are percentage. So dollar value. And the calculation is not per order. This is per customer.
Correct.
So it's
per customer throughout their entire life, their entire journey with you, right? So they might have bought once and never again. Some of them might have bought once and then 6 months later bought again, and it could be a different product, right? It's literally every touch point they've had in the journey with you on Amazon. Yeah.
And then you break that up into 3 month lifetime, 6 month, and so on and so forth for every customer. But the important thing here for those who are listening, that they need to get into separating the orders per customer ID in order to measure this, if they want to do it themselves. And then it gets complicated, because then you've got this relationship situations between transactions. But nevertheless, so take the gross sales, whatever the top line is, minus the cost of goods sold. That's the landed cost of the item, minus Amazon's commission, minus Amazon FBA fees. If it's FBM, now you need to pull order by order whatever your shipping cost was, and then factor that in. It's either the FBA or the FBM cost, and what is left is
the actual profit that you made on that order. The one thing I would add though is that you it's not just the gross sales, it's you want to subtract out any discounts or coupons and all that sort of stuff as well.
Yes, of course. The gross sales minus the any cost of that particular transaction. Okay, now comes the other bits and pieces. Tell me if they are considered never or elsewhere or whatever. One is the easiest one is other bits and pieces like storage cost, this, that, the other, or you don't really include them in this calculation, right?
We can include them. We have had customers. I mean, ultimately it also comes to a point of materiality, right? I'm a numbers person. I'm a precise person, I guess, but I'm also a pragmatist, right? Like, is it actually worth the effort? If, for instance, your lifetime value is $20 without the storage costs after 3 months, and then it goes to $20.05, or after 3 months once you put it in, it's not going to change the business decision you're making, right, at the end of the day. And so there's always this, like, could we be more accurate? Okay, probably. Is it worth the effort? Is it actually going to change the business decision? Probably not, and therefore not worth the effort, right?
What about refunds?
Yeah, that's important. That's definitely important, because there's certain categories and things like that, like clothing and that have higher refund rates than normal, right? And that could absolutely materially change the LTV, especially on a cohort basis, because if there are issues around the quality of the product, or I don't know, all sorts of things like that, it's important. So refunds are material. I would say going around the edges around storage costs, unless you're in a particular category where there's something very, very large storage cost, or there's a specific reason, I would say probably ignore that. But refunds would be important.
So that means then whatever your net sales are after discounts or anything, then you want to discount that by your typical refund rate, and then bring in the cost of goods sold.
Yeah, you can discount it by the refund rate, or if you've got actually access to the orders API, you'll know that it's a refund. So it's not that you're applying a refund rate. It literally just says, like, this is a refund against this order ID, and you can just subtract it out.
I see.
But yeah, I mean, again, it's a question of, if you're doing this via like software API stuff, you can do it, that way. Otherwise, if you're just doing it, I don't know, by some sort of very big Excel sheet, just do a refund rate, right? It's not worth the extra effort.
I want to introduce Cellcore to all my listeners. As you all know, it's essential to add another selling channel to Amazon. Even though Walmart is the natural addition, you need the know-how to hit the ground running. Cellcore is a Walmart-approved agency for launching and scaling Amazon brands on Walmart, and even getting you into Walmart stores. They manage over 400 brands and 100,000 products. They were kind enough to offer my listeners a free comprehensive audit and a $500 statement credit. Visit www.cellcore.co/legends and mention Amazon Legends to activate this offer. But do it quickly, because this offer may not last long. www.cellcore.co/legends. Okay. What about the big one? The advertising, the PPC costs and everything.
Yeah.
So how do they get factored into?
Yeah. So I guess there's sort of two ways of doing it. Number one, you could just reduce the LTV by the PPC costs. We prefer to look at it as the other side of the coin, which is the metric I mentioned right at the top, which is customer acquisition cost, right? Okay. And so for us, the PPC, or all the advertising stuff, will get calculated in the CAC. And ultimately what you're doing is you're subtracting the CAC from the LTV. You're saying LTV minus CAC, right? So when you talk about an LTV, in a strict sense, it should be after your customer acquisition costs, right? Once after you've recouped everything you've spent to acquire the customer, then how profitable is that customer?
Okay, so you have walked right into what I wanted to talk about because that's the structure, right? So on one side you have your lifetime value, and on the other side you have your cost to acquire that particular customer, and that's the advertising, and not necessarily just your PPC. It's all your advertising efforts going.
Yes. So this is also a very tricky conversation because the most simplistic way is this idea of, you know, how much did I spend in advertising to acquire a customer, which is to say, let's add up all the ad spend for, let's say, I don't know, sponsored brand, sponsored display, sponsored brand video, sponsored products. If you're running DSP, right, put that in, and then divide that by the number of new to brand customers for that month or for that period, right? So yes, that's, I think, is a decent way to do it. Then you can certainly get a lot more complicated, I guess, which is, some people will call it like a fully loaded customer acquisition cost, because ultimately, if you think conceptually, you're trying to capture all the costs associated with acquiring a customer. And so yes, advertising, like the actual media costs, are one part, but ultimately you're paying people and using technology also to help with acquiring customers, right? So should you include the costs of your PPC software if you're using it? Should you include the cost of people's salaries or the agency costs if you're using an agency? Because what are they doing? Most of the time, you know, they're pretty much about acquiring customers. So you can get into the weeds and you can ask 10 people for 10, and they'll give you 10 different definitions. I think a decent starting point is just to say, keep it simple, which is to say, let's just add up all the, you know, actual media costs, the ad costs, divide that by the number of new to brand customers. And that's telling you how much do I have to spend in PPC to acquire a new customer.
Okay. So, yes. So, I mean, those are all things, frankly, the same approach applies to calculating your fulfillment cost if you were fulfilling it yourself, because one order, people think that, oh, it's going to cost me, I ship by USPS and mine is no more than £1. Well, I mean, it's going to cost me $5.50. Well, no, it's not. What about your warehouse? And then what about the rent and the insurance, right? So they all have. So, but going back to customer acquisition cost. So I think it's fair for listeners to say to themselves, okay, I'm going to have two different numbers. One is going to be just bare spending on bringing visitors so that they can become a customer for me. The other is with everything else, with the agency fees and whatever they decide, and they can contribute. So, but I want to define the calculation again. The calculation is, let's focus on the bare minimum customer acquisition cost, and that's the paid advertising, all added up per ASIN.
Yes, because if you want to, if you want to analyze the, let's say, the lifetime value on a per ASIN basis, then you also got to look at, you know, like for like, you got to measure that against the CAC on the per ASIN basis. So on the CAC side, it's simply going to be sponsored brands, sponsored brand video, sponsored products, sponsored display per ASIN per month, let's say, and you're going to divide that by the number of new to brand customers who bought that ASIN, who for their first purchase bought that ASIN.
Okay, advertising spend is not always possible per ASIN on the sponsored brands. On the sponsored product, yes, but so how do you deal with those? That
you can weight them. You can weight them like sales weighted or spend weighted, etc., across the three ASINs. Let's say on sponsored brands, things like that. Again, it's there's an issue, not an issue. It's just a question of materiality there. Like if your customer acquisition cost is $10 and it goes to $10.07, you know, that's not, again, not going to really materially change the calculation there. But so what we would do is, historically, what we've typically done is just take it like either spend weighted or sales weighted across the three ASINs and sponsored brands, for instance.
So we kind of shifted a little bit, and I want to make sure that we are keeping things in the right kind of silos, so to speak, so that we can compare. So customer acquisition cost is total paid ads divided by new customers acquired during that month. So And of course, it's not instant because you may be spending on the 29th and 30th and 31st of the month, but the customers don't show up until the following.
Yeah.
You just simply go by the calendar month.
Yeah, I mean, you could do things with the attribution window there as well, for sure. And also, Amazon's a little bit inconsistent on their attribution windows as well, right? So you've got 14 days for, I don't know, DSP, and you've got 7 days for sponsored products. You know, the API actually, if you really want to get into the weeds, the API you can change that, right? You can actually say for sponsored products, I want to use 14 days. But anyway, yes, so you could run into some attribution period or window issues there, but there's another, I think, probably even bigger issue to talk about, which is when you're talking about ad spend, should you also be including, firstly, you want to subtract out remarketing budgets, right? So that's got nothing to do with, by definition, with new customer acquisition. So you want to subtract out that. You also want to be subtracting, and this is the part that gets a little bit fuzzy, I would say. What do you do with branded terms? Because in general, you know, how many non-branded terms, it's kind of safe to say that those are very targeted towards new to brand acquisition, right? People just searching for, I don't know, best vitamin A supplements or whatever it is, right? If people are searching for specific brands, they could be new to brand, but there's also a very high chance that they're not new to brand. They've bought it before and they want to buy it again, so they can, there's a few journeys they can take if you want to make a repeat order. You can go into your order history and buy again, which is actually what I do. You can subscribe and save, I guess, right, for a bunch of these ones. Or you could just put the branded term in, right, and search for it and buy it that way around. And the biggest frustration I've had whenever I talk to the Amazon Ads API team for years now, it's always been, there's been no actual way to connect the ads data to the retail data in that very, very specific way. So you can't actually say this very, very specific ad converted at this very specific time, and therefore we can match it to this very specific order. And so I'm probably getting a little bit too much into the weeds with all of this, but that basically means you're left with like these branded terms, which you're not quite sure what to do with them. Are they, how much of that is new to brand and how much of it isn't? Remarketing is safe to say you can remove that. Non-branded, it's safe to say you should include that. But then the middle ground is kind of what do you do with branded? The Amazon Marketing Cloud, interestingly, is starting to solve some of these problems, because on the AMC, for those listeners, I guess the Amazon Marketing Cloud is sort of a new product, but it's really interesting that it can, it's not exactly tying the dots that it was this ad in this specific order ID, but you can get a better sense of that middle ground there around how many of my branded terms are contributing to new to brand versus repeats. So it's a very long way of me answering your question, but when you talk about all your ad spend, it's not always the case that it's all your ad spend.
Yes. So some of them, okay. So let's break it down. So first of all, sponsored brands, sponsored products, and then you have all those different programs, some of which are not reporting by SKU. You just have have to include them in the calculation, except that you have to prorate or whatever the case may be per SKU. But again, this is not a SKU-based calculation in the sense that this is about the customer base. So what you're looking at is what is your total ad spend. And what you're going to do is you have to be tracking how many customers you had on the books at the beginning of the month and how many customers you have on the books at the end of the month. Whatever the difference is, those are the ones that are new customers you acquired by that spending. So you divide that total by the number of customers. That's your customer acquisition cost during that month, right?
Yes. So there's certainly one way to do it. Or if you're doing it via the API, you will know whether someone's new to brand when they place the order on the 3rd or whatever as well, right? It's literally here's like a unique ID or something for that individual. Have I seen this person before? The answer is no, they're going to be new to brand, right? So you don't have to do that subtraction, but that's definitely just another way of doing it.
Rael, I'm old school. I'd like to know the formula calculation, and then I'll let somebody give it to me, but I'll from time to time I'll go back and check.
Fair enough. It's always a good way to test, if you're getting it. So yeah, for sure.
Okay. Now, in that calculation of the total paid spend, retargeting completely excluded, just like refunds need to be excluded because they are your controllable inputs, so to speak, that you may not always be there. So what is your bare advertising?
And the objective is totally different. You're not trying to acquire a new customer. You're trying to get an existing customer to buy again, right? And so it's not about customer acquisition cost. We can chat about, if you want, something like the cost of retention, or something like that, right? Which ultimately
this thing is this. So I go to Amazon and I look at stuff and I don't buy it. Well, guess what? I'm seeing that item. I haven't yet bought. So, but that's retargeting, no? So it's bringing me back.
Yes. So I guess there's a clarification of what I guess maybe we're talking past each other a little bit. So you've got different options when you want to do remarketing or retargeting. Like there's definitely an option to say, go target people who have looked at my product and haven't bought it, or added to cart but didn't buy it, right? So try just get them to buy. That should be obviously counted towards new to brand, right? Because it's a different. I'm talking about remarketing in the sense of someone has bought and I want to go get them to buy again.
The devil is on the details.
Yeah, and that's a good point. It's a good distinction to make. Absolutely.
Yeah. So let's now define this. Retargeting include, remarketing exclude.
Yes, if by retargeting you mean people who have shown some interest but not actually bought the product at all, sure, absolutely include. Cool. Because it's everything to do with acquiring a customer. So yes, that's absolutely part of acquiring a new customer.
Okay, so when you approach it this way, it really doesn't matter whether it's the numbers are at SKU level or not. You can look at your total advertising, paid advertising, and then subtract the remarketing piece. Yeah. And then whatever is left, divide by number of new customers you acquired that month. That's your customer acquisition cost, right?
Yes. And it brings up another question, because and this comes up quite a lot, which is to say, when you're analyzing a lifetime value, what does it mean to say, to filter by a particular ASIN? So let's say I want to look at the LTV, but now I'm looking at ASIN, I don't know, my whatever you want to call it, right? My 30-day vitamin A supplement. So in our world, and again, this is perhaps a judgment call, but in our world, what we would say is when you filter for an ASIN in this analysis, you're filtering by the first order or the first purchase only. So what we're saying is that someone was new to brand and they bought this vitamin A as their first purchase, but that's it. They could have bought vitamin A or vitamin B, C, and D as the second, third, and fourth order. That's it. Right? Because again, you're after the customer level and the analysis and the customer journey, not an ASIN level. If you want a repeat order rate for an ASIN, sure, like that's a different metric and we can talk about whether that's useful. But a lot of the time you're not, unless you're a very, very strong, like subscribe and save type brand, a lot of people are just buying different things, right, from you. And you're not capturing that with an ASIN repeat order rate. This is very, very different. This is a customer level analysis. And so again, when you're in the dashboard or when you're thinking about the analysis and you want to say like, okay, what does it mean to say, I want to filter by this ASIN? It's in our world, it's simply saying we're filtering by the first order was that ASIN, but no guarantees what they bought next. So to bring this back to the CAC side, that's why when on the customer acquisition cost, when you're doing this per ASIN, you can actually match those two, right? You can subtract the CAC from the LTV because they're both going to be for that same ASIN because it's only for that first order.
Right. I mean, that is really honing in on what really matters to you. So you are measuring the LTV at ASIN level as well as customer, and then you're measuring the customer acquisition cost at ASIN and customer level, and then you can see marry the two. And then maybe these decisions, so this was going to be just a few more minutes. We covered this before we wrap up, was, okay, what do you do with this? So what is the relationship and what are the actions to take? Share with us some of those, because there's many, there's many. Ultimately, there are two numbers we are comparing against each other, and the different scenarios come out of those two numbers. And then what do you do in those scenarios? So share with us some of your thoughts.
Yeah, absolutely. So generally speaking, I would say most brands would fall on a spectrum, which is On the one hand, you can be very, let's say, growth focused, and your focus is to, let's say, gross sales or volumes and new to brand customers. And on the other side, you can be very profitability focused, right? And what that means is you're going to have how much to focus on growing repeat orders and how much to focus on new to brand acquisition, right? Those are kind of, I guess, conceptually, it's like, well, what's the right ratio of new to brands to repeats or repeats to new to brands? If you're very profitability focused, the majority of your orders should come from repeats, right? I've seen businesses where 85% of all orders are just repeats. And on the one hand, they're super profitable, right? And they're not paying for most of those repeat orders because they're subscribe and saves, or you don't have to show ads to them, right? They're just kind of doing that. But then there's obviously a question too of where's future growth going to actually come from, right? And so you don't want to go too far over into repeats and all of that, because then there's a question of, well, yeah, what if something happens? Where's future growth coming from? On the other side, if you are in one of those categories that should have a lot of repeat orders, but you're too growth focused, meaning for every 10 customers you get, if every 10 customers that buy from you in a month, 9 of them are new to brand and only 1's a repeat, that's a very leaky bucket, as we say, right? And that is not sustainable, because you're going to have to, you have to acquire so many customers all the time at a great expense, and hardly any of them are coming back effectively. So those are just like setting the goalposts, right? Of like, you're going to be somewhere in that sort of spectrum. So it really depends on each individual brand, how much emphasis you want to put on profitability versus growth. What is the right ratio of new to brands to repeats that you actually want buying from you in any given month, right? And it's a trajectory. I mean, the easy answer is to say, well, the best ones I've seen kind of do both, right? There's month-on-month growth of repeats. There's also month-on-month growth of new to brands. But that's I guess pretty rare. But also what I've seen is a really good strategy is even within your own catalog, you can have different objectives, meaning the hero ASINs, let's just focus on profitability. Let's just get, as many repeat orders and subscribe and saves or whatever it may be, and maybe 70-80% of all the revenues coming from repeats for those hero ASINs. But for the sort of second tier ASINs and all the rest of them, let's go focus on new to brands for them and build them up, right? And so like that's kind of the way I would look at doing that. But fundamentally, if you are in that growth objective, the most powerful thing that a lifetime value allows you to do is to not break even on the first order, right? It gives you the numbers behind and the comfort that that if you want to pursue a strategy to say, I only want to break even on the second order, and that might take me 3 months, this is what it means. This is how much I can now pay to acquire a customer. And this is what it translates to in terms of a ROAS or an ACOS. So let's say, for instance, on the first order, your break-even ACOS is 30%, right? But after 3 months, that's now jumped to 50%, because some of your customers are coming back, right? And some of them are coming back within 3 months, and you're making a profit. That all of a sudden now, what do you do if your break-even ACOS has gone from 30 to 50%? Well, you've got so much more freedom to pursue all sorts of different things, right? You can obviously afford to pay much higher CPCs, right? You can compete for terms that probably would have been out of reach if you want to break even on the first order only. You can invest in higher up the funnel things like sponsor brand video or DSP or whatever it may be. You've just got so much more room to work with now that you are breaking even on the second order. And you've got all, as I said, you've got all the numbers behind that it checks out, and here are the targets. I regularly come across businesses that their break-even ACOS is over 100% at the 6 month mark, right? So their target ACOS is like 120% because but they got to wait 6 months. Now the trade-off, of course, is if you're having to wait longer to break even, that obviously affects your bank balance, right? Your balance sheet, your cash balance, right? And exactly. So, anyone who runs a business, that's, cash is king and all of that sort of stuff. So it's very rare for us, at least, to recommend breaking even on like 6 months or 12 months or anything like that. It's always just start off at 3 months. Chances are your competitors not doing this sort of analysis, and you're already having a big jump, right? 30 to 50% in terms of an ACOS. And you can do so much more with that. right? You've got all that freedom now in terms of your keyword strategy and the rest of it. So I think that's probably one of the biggest uses, let's say, of lifetime value and customer acquisition cost.
Yeah. I mean, look, at the end of the day, what you are saying is, well, if I have X number of customers, this is how much they are worth to me. And then I'm going to spend so much of it in bringing so many on board. And then you can look at it and see where that's going to leave you. And then if it's not enough, you have to look at the situation.
Yeah.
And of course, some of those that you are able to bring back, that will increase the lifetime value at zero cost, because there is no acquisition cost for them anymore. So it's a nice mix.
Yes.
And I guess, again, the answer is which one of these is right? Well, it depends on where you are in your journey as a company. Yeah. If you are at the beginning, you are acquiring. If you are like somewhat mature, you really ought to be retaining and increasing the value. So
yeah, the most successful and biggest businesses are going to have really good customer loyalty, right? I mean, that's not a particularly that shouldn't be a surprise to anyone, right? The biggest brands are the ones with the most loyal customers. I mean, if you think of, I don't know, what's my lifetime value with like Apple or something? I mean, it's I hate to actually think of what that number would be, right? So yeah, I mean, that's how you build success, really big and successful businesses. It's, as I said right at the top of the call, if it's about brand building, which we think it is, then one of your most valuable assets are your loyal customers, and that's measured by repeat orders, really. So yeah, I mean, the whole Amazon world is, and this is, I blame Amazon for this, right? They don't give you the data, but they're all focused on like what happens on the first order, right? And that's just not reflective of the business if you're in one of these categories. It just isn't, right? It's stuff that people buy again. Amazon's failed these sellers,
wait
right?
A minute.
Yeah.
Wait a minute. Amazon is not playing that game. Amazon is playing the game of bringing that customer back to Amazon.
So Amazon's maximizing Amazon's lifetime value,
exactly.
Right?
I mean, think about Amazon's
absolutely
lifetime customer value.
100%. So Amazon for sure is all about maximizing their LTV, right? Like as Rael, how many times they couldn't care really which brands I buy from, as long as I'm coming back and buying again and maximizing that LTV. So yes, it's a completely different like optimization problem around their LTV and not the individual seller's LTV.
Well, in fact, the founder of Zappos, you familiar with the story?
Yes.
He's another case study that completely made the case. In fact, I saw him.
Yes, he was super aggressive with that stuff. I remember.
Well, I saw him at an event. This guy was real spiritual kind of guy, where he was completely committed to what he believed in, and you could tell the kind of emotional scars that he received in defending against investors. And sure enough, of course, it paid off. So, well, just as I expected, it's a delicious conversation which can go on forever between you and me. But we're going to have to wrap up the business conversation here. I want to move on to getting to know you, because someone who has this kind of knowledge and interest, who is Rael Cline, is what I want to know. So take us back to your beginning. So tell us, where did you grow up, and share with us some of your life experiences.
Yeah, sure. So I grew up in Johannesburg in South Africa. So I spent the first 23-ish years of my life in Johannesburg in South Africa. So interesting, I guess, time growing up in really the 90s, I guess, and sort of early 2000s. My father, pretty entrepreneurial. He's sort of, I guess, as a life insurance broker, but then got into just sort of general financial advisory type stuff. But he struck out on his own at a pretty young age, right? 2 young kids, and very much of this sort of attitude that to go it alone, and the freedom and hard work that comes with that, right? Juxtaposed against each other there, but but very much instilled in me that I should be thinking about doing my own things. I mean, obviously, sort of support me in whatever I chose to do, but like very much prepared me for, and he would share a lot of the stories with me around some of the decisions he had to make as, you know, as an entrepreneur, and striking out on his own and building his own customer base, and when people losing big accounts, and, you know, all that sort of stuff. So, you know, pretty transparent with me on all of that. And yeah, I mean, you know, that was something that I think instilled in me in my teenage years. I went off then, I did an undergrad in finance and economics in South Africa, in Johannesburg. I nearly studied a PhD in that, and thank goodness I did not, I can tell you. I think that was, you know, people think some of the best decisions in your life was what you decide not to do, never mind what you do. But I didn't do that. But I did come in 2010. Well, sorry, then after studying in South Africa, the undergrad in finance economics, I did work in private equity and sort of very sort of financy, lived in sort of spreadsheet type jobs. Wasn't really machine learning around in those days. So you're running Monte Carlo simulations, I guess, in Excel, as sophisticated as you can get there, which is interesting. But I then went and studied in Cambridge in the UK. I did a master's in finance in Cambridge in the UK. So again, this is not really entrepreneurial, right? This is probably the opposite of that. Where typically if you're going to do something like that, you are going to join, I don't know, a private equity company or a bank or a central bank or whatever, just stick in finance, right? But it's really interesting. So I finished the master's in finance there, and then just ditched finance altogether, got out of finance altogether. I mean, part of it was like pull, part of it was push. Pull meaning it's always something I wanted to do, is to kind of struck out on my own. But the push side of it was also pretty strong. I'm not going to pretend about that, which is it was a terrible time to look for a job in finance in, what was it, 2011. It was a European sovereign debt crisis, and people couldn't find jobs, and all sorts of things going on, at least in Europe at that time. And I just, basically, long story short, I came across online advertising, specifically programmatic advertising. Now, this is a world where computer algorithms in real time, literally milliseconds, place a bid in a live auction to show an ad to someone. So as a user, you go to a website, whilst the page is learning, what's actually happening behind the scenes is thousands or billions of times a second, honestly, across the world, computer algorithms are submitting bids in auctions to show an ad. So the winner is chosen, user's ad gets shown to you, end-to-end milliseconds. I mean, it's quite incredible, that infrastructure. But what's interesting from my point of view was, coming from a finance background, the finance industry had been doing stuff like this for decades, right? Computer algorithms to buy, sell stuff in real time. So for me, it was, again, I'm probably getting my nerdy side out here and way into the weeds, but what I was really interested in is to find out whether we can actually provide derivative products for online advertising. So I don't know how many of your listeners are even familiar with this weird world of derivatives, but it's basically stuff like, I pay you a small fee today, and at some point and at a point in the future, I have the option of buying something in the future, right? Or selling something in the future. Or it could be just straight out, I promise to buy something for this price in 12 months' time, or sell something for this price. Anyway, the online ad industry was very sort of real time, and we were looking to bring it into forwards and futures and options and all these sort of things on the derivative side. Anyway, long story short, I keep saying long story short, but I was Googling who else is kind of looking at this intersection of finance and online advertising, two industries really that had never overlapped, right, in any way. And I came across a computer science professor at UCL, University College London, who was all about applying financial techniques to online advertising. A whole bunch of research in applying portfolio theory and all sorts of things in online ads. So I got together with him. We decided to spin out of the computer science department a company called Media Gamma. And Media Gamma, at least in the beginning, was trying to do these things, right? Like, can we go? Because think about it, if you're doing a product launch, and this is, I guess, one of the use cases, if you're doing a product launch that's, say, in 6 months' time, in some point in the future, 6-12 months' time, how do you reserve that space up front, right? And what happens if that launch is delayed, right? Remember, some of these things are like the option to do this. You're not obligated to do this. And so it builds in that flexibility to do that. And so there's all sorts of reasons why, even as a publisher, if you're on the other side, you're hosting the website, you're a news website, you can, again, have an additional revenue streams. we decided that was actually too tough to do. And it's funny because if I look back at like my original pitch deck and all that kind of stuff, it's just wrong in so many ways. You've got like hedging charts and like just ridiculous, right?
It's not exclusive to you, Rael. When you first come up with the idea, it's all kinds of things.
Yeah, I mean, like two sort of, a computer science professor and then a data guy like me or something, trying to tell a story, on like pitching. It's not going to end well, right? So anyway, what we ended up doing ultimately is building custom bidding and selling algorithms for online advertising, right? And so what price should I pay? What price should I submit in this auction? Or if you're on the other side, or you're on the publisher side, you're hosting the website, what reserve price should I have in this auction? So a bunch of computer science, PhD level computer scientists doing all of this sort of stuff. And we built a business called Media Gamma. And we are most successful, and this is the sort of, I guess, tying with Nozzle eventually, our most successful customers were the mobile gaming companies, because they were incredibly quantitative and they were interested in lifetime value, right? Because when you think about, well, we're back to customer acquisition cost and lifetime value, because when you want to submit a bid in an auction, it all depends on how valuable you think that person is going to be if they can convert. And how do you know how valuable someone is? Well, we would get the data from the mobile companies saying, here's the 3-month LTV or the 6-month LTV. So like, here's the feedback that you need in order to improve the algorithm, right? Like, how valuable were these people ultimately? And so we sold that business it was the pandemic, right? What was it? It was July of 2020 to a company called Beeswax, a New York-based company. And then, yeah, I mean, I came, coming across the Amazon ecosystem where it's possible to sort of do variations on the theme there ultimately, right? You've got the data to do the LTV, you've got some of the customer acquisition, well, you can do the customer acquisition cost side too. And this is not really being adopted or leveraged by the Amazon ecosystem. This is 2020, right? Yeah, 2020. And yeah, and therefore, that's the opportunity of Nozzle. Like, Amazon's investing a lot in the API ecosystem, into the ads and retail APIs and all that sort of stuff. But if you compare the Amazon sellers, I guess, to like what the D2C community have known for a long time, like this idea of not breaking even on the first order is forced upon them, I guess, years ago in the D2C world, because it's just the customer acquisition costs are way too high anyway, right? And so, yeah, I mean, that's kind of our opportunity ultimately.
So, obviously you're very passionate about numbers, and you spent your whole life. But one thing that I picked up as a common thread is it's all numbers, starting from your father, because your father was selling life insurance. What is that? It's all numbers, right? So he's dealing with numbers.
Actuaries, yes.
Yeah, and then moving into financial services, and that's also numbers.
Yeah.
So is that something that was part of the environment growing up at home, always dealing with numbers?
Yeah, it's interesting you say that, because you're absolutely right. That's, a common theme. But my father's actually not a numbers person. He's much more a people's person. And I think that's also what taught me an important lesson. And this is the first time I guess I'm kind of clicking or thinking about it, which is, you can have all the numbers in the world, right? But if you can't get on with people and you're not a people's person or any of that sort of stuff, right? Like, so much of it is on trust, particularly in financial services, right? And if you're not able to tick that box in a meaningful way, then you're not going to be successful either, right? It's underpinned by all the numbers, but at the end of the day, someone's still got to, you still have to be a good person. You still got to build trust with people. And when things go wrong, I think people judge you when it's easy to judge people when things go right, but when things go wrong is ultimately when you should judge how do people react, right? And I think that's also an important lesson that he taught me, is when things go wrong, what do you do? Or there's a fight with a claim that you're making in the insurance and against the insurance company, it might not be worth your while as an individual financial services advisor to like spend a lot of time trying to fight for it, but is it the right thing to do, right? That stuff like that. So I think it's actually interesting. He was more of that person than sort of the underlying numbers as well.
So how would you say you compare to your father?
Well, I'm probably skewed more on the numbers side. I'd like to think that I can get along with people, but I don't know. The jury's out maybe a bit on that. But I think he's probably, yeah. I mean, I'd say he's better with people, right? Ultimately,
your story about your father reminded me, and your example about what happens when you judge when you fail. It's two things. One of them is the book called Good to Great. And have you read that book?
I haven't, no.
Oh, I highly recommend it.
Yeah,
And
check it out.
you will especially like it. And so basically the concept is this. It's Jim Collins wrote this book, and he took I forget the number, I think 25 companies that are high growth, but these are not companies that people know about. And we're talking about stock market, public.
Right.
So nobody knows. These are public companies, extremely successful, and as yet they are not on anybody's radar screen. And then he created what he calls comparison companies. And these are companies that are in these exact same industries that everybody knows about. But their growth rate is nowhere near.
Right.
So
interesting.
So you've got these high growth companies and the comparison companies, and then he studied, and then from that he drew conclusions on what makes a good company,
interesting
comparison company, a great company.
Yes.
So, and one of them was, of course, everything comes down to leadership, but also culture and a few other things that I'm not going to get into. But the part about the leadership. So he said that the comparison companies were the CEOs. When the company did really well, he would be on TV, radio, talking about everything and then taking credit. When things went bad, spokespeople were
get the lawyers to deal with it or something. Yeah.
CEO would always be behind the scenes when things went great, but he was always in the forefront when things.
Very interesting. Yeah. That's a good lesson. I like that.
I remembered your conversation. The other one is I think is a nice ending, which ties to what your father's example was for you, and that is from the movie A Beautiful Mind. I'm sure you've seen the movie.
It was a very long time ago, so I probably don't remember what you're about to say. But yes,
if you remember, right at the very end, he's accepting the Nobel Prize. He gives a speech, and his wife is sitting in the audience, of course, and he says, all my life, I look for solutions. And I looked at the numbers. So I look for solutions in numbers. Solutions to everything, solutions to life. He says, what I realized years later, that the only solution that I needed was sitting right next to me. And he looks at
amazing. Yeah, I mean, it's easy to forget how emotional, what emotional creatures we are, ultimately are, right? So 100%.
Yeah.
Really interesting.
Well, I love the conversation.
Yes.
Thank you. Well, so tell us, how can people reach you and, share your contact information with us?
Yeah, I guess my email address is rael.cline, rael.cline @nozzle.ai. LinkedIn, very responsive on LinkedIn as well, so you can just look me up there. Very happy to have these conversations. As you can tell, I'm quite, passionate about that. So if you've got questions, queries, alternate ways of doing things, better ways of doing things, critiques, any of those sort of things, totally open to all of that. So I would love to hear from you.
Thank you. And of course, anybody who wants to sign up, they can go to nozzle.ai and sign up.
Yeah, there's a free 14-day trial as well. So you can just, and if you just message me and say I've signed up, I'm happy to have a call with you just to go through the numbers and stuff as well. No problem.
Great. Thank you, Rael. Thank you very much. Great conversation. And everybody, pay attention to these numbers. Go sign up for nozzle.ai, because you can't live without it.
Thank you so much for having me, Nick. It's been great.
Before I wrap up, I want to remind everyone to visit www.cellcore.co/legends and mention Amazon Legends to get a free comprehensive audit and a $500 statement credit. It's time to conquer Walmart with Cellcore by your side. Also, don't forget to get your winning product detail page from mindfulgoods.co and get up to 600% boost in your sales. You will get $100 off the service. Visit www.mindfulgoods.co/legends and enter the code Amazon Legends to enjoy your $100 off. Thank you. And this brings us to the end of another episode, and I'll see you on the next one.
If you enjoyed today's episode, be sure to subscribe, rate, and review the episode, and share it with someone you think would benefit from it too.